What's going on, guys? Welcome back. So in this video, I'm going to be going over one of the cheapest stocks in the stock market. I'm going to be going over one of these companies that I've covered numerous times here in the channel that at this point in time has depreciated so much in share price that I just do not understand why Wall Street is pricing it the way that it is. This company creates a massive amount of free cash flow. This company pays an extremely high dividend yield. And this company has such a strong moat that I don't see it going away anytime soon in the near future. And that company is Altria, ticker symbol MO. Now, before I get into the video and I explain why I personally believe that Altria is the cheapest it's been in an extremely long time, and why I personally think Altria is a screaming buy right now, I do want to caveat this whole video with saying that I am not a financial advisor. All the things I talk about here on this channel are, just my opinion of financial markets. I do quick calculations based off models that you can build at home, and then I interpolate the information that is out there in the overall stock market, what the company's coming out with, put it into my models, put it into my perception, add in my risk tolerance, and then place my bets with my investments accordingly. So definitely don't take this as investment advice, but there's a lot of interesting things going on right now with Altria, and I wanted to share that with you guys here. So if you guys are interested in that, you're interested in figuring out why I think Altria is an extremely cheap company right now, stick around to the end of the video, and without further ado, let's get in the video. Now, so the first thing I wanted to take a look at with looking at Altria and really understanding, okay, is Altria right now trading at a discount? Do I think right now it is a basement price? And do I think there's a lot of deep value in this company? The way I took my first approach to it is at a high level, I looked at, what almost every investor looks at the first glance of a company, is you want to look at the PE ratio. Now, as you all know, the PE ratio is probably the most common ratio used when valuing a company and when looking at a stock. And, it pretty much tells you, like, okay, for the amount of earnings that the company's bringing in every year, how much am I willing to pay for those earnings? And generally in a multiple. You can have companies that are high growth, that you have a massively high PE on, and then you have companies like Altria that are relatively stagnant, that generally demand a much lower multiple. However, the multiple and at what people are willing to pay for it kind of lets you gauge the overall pessimism or optimism in a company based off of what it has traded in the past. Because generally, if the business model hasn't changed much, people should be willing to pay the same multiple this year that they were last year, the year before that, assuming nothing else in the business really changed. So taking a look at Altria's multiple right now, it stands at about a 12. Now, you look at that and compare to the overall stock market that trades at a 22, that is extremely cheap. However, Altria, as what I said earlier, is because it's not a fast grower, it normally trades at a discount in terms of its multiple to the overall stock market anyways. But the interesting thing is that over the past 5 years, Altria's average multiple trading in the stock market has been a 16. So you can see right there that Altria's business model realistically hasn't changed much in the last 5 years, but investors are paying a significant less amount of money for their shares currently than they ever have over the past 5 years. Now, a lot of that has to do with the headwinds and everything that's going on with the company right now, but ask yourself this: if you do more due diligence, just on a fair like a face value type of perspective, would you rather pay a multiple of 12 or a multiple of 16 for a company that realistically hasn't changed? So if you have been invested in Altria over the past few years, right now seems like a screaming buy compared to any other point in time that you could buy it over the past few years. So that's just something I wanted to keep in mind. All right, and the next thing that I really want to keep in mind with you guys, just looking at Altria and how it's been trading in recent years in comparison to what it's been trading for right now, is you look at their dividend yield. So when you look at their dividend yield, essentially what type of return are you getting in terms of cash flow for investors that are seeking, their dividend portfolio, they're seeking cash flow on a monthly or quarterly basis. They want to be able to live off those dividends and pay money on it. Generally, when you look to companies like Altria, other sin companies or pharmaceuticals, you get the most bang for your buck with those. But Altria is trading for an extreme discount in this case as well. So Altria is trading with roughly a 7.6 dividend yield, in comparison to what they normally pay over the past 5 years, which was a 4.75. So there's a big difference compared to what type of yield you're getting off Altria now than you've been getting at all in the past, over the past 5 years. And now Altria, again, has been notorious for being a big dividend play. And even though it was getting, paying a hefty premium in its dividend compared to the overall market 5 years ago, right now it's paying an immense premium to the overall market, and people are just looking at it and saying, nope, not for me, too much risk, walking away. And what I'm trying to look at and grasp in my head is that if you're a yield-seeking investor and you're someone that wants a high dividend yield, you gotta understand that these high yields only pop up when there's a lot of doom and gloom surrounding a company. And you want to be, to quote Warren Buffett, you want to be greedy when others are fearful and fearful when others are greedy. So right now, with the share price being depressed as much as it is, and it's making the dividend yields come all the way up to a 7.6%. Just a couple of months ago, it was trading at over an 8%. Right there, it seems like a lot of fear is priced into that stock. And so now we're going to take a step back and look at the actual fundamentals of the business. Because as we all know, you can go on any stock screener and just kind of click in like, okay, what's a low PE, high dividend yield, boom, looks like that's a cheap value. No, that's not necessarily how it goes. There has to be fundamentals, supporting the fact that this is a bargain and not a value trap to investors. So you need to dig a little bit deeper and understand, okay, what's actually going on with the underlying business? Is this going to still be profitable 10 years from now? Is it still going to be in business and giving me that dividend 10 years from now? So when you take a look at it and you look at the revenue over the past 5 years has been growing at around a 1% clip, which isn't too great, but it's not awful. It means that it's still growing slowly. Again, this company's over 100 years old. Don't expect a massive amount of growth with it. But then when you look at the past 10 years, it's been growing at about a 5% clip. So obviously it's slowing down in trajectory, and there are different things, different catalysts that are doing that the company's trying to say make Juul one of it. It's trying to hit back on that 5% mark. But no matter what, even before Juul was factored into anything, the company's still growing at about a 1% clip. And that's on their top line. When you look at their bottom line or on their EPS, the company is growing over the past 5 years, has grown at roughly a 10% clip. And that has to do with the fact that, as we all know, Altria is a very sticky business. Its products are pretty sticky, and the customers that are coming to their shop, let's say, they're going to continue to do that generally for the foreseeable future, if not the rest of their lives. So they've been able to squeeze out a lot of money out of their EPS. So even though the company's top line isn't growing a lot, the bottom line, the money that's going to shareholders, has been able to appreciate at a very fast rate in retrospect to everything else. Now, if you stretch it out a little bit farther and you go over 10 years, this gets closer to a 5%. And that's just kind of because different things that are going on with the company and, the company dumping in a CapEx and buying things. There are a couple of years that have drastically suppressed their EPS. So there are a couple of outliers that are really skewing that number. But their EPS, more or less over the long term, is relatively stable. And even at a 5% clip for a company that is as old as Altria is, that's still a decent yield and a decent growth on your, owner's earnings. And now going back to cash flow for just a bit, because I'm sure a lot of you guys that are interested in a company like Altria are really interested in the cash flow yield and the dividend yield that the company can provide you. You want to look at, the payout ratios. Because the payout ratio, obviously, if a company is paying out more in a dividend than they actually are taking in, such as you can look at like a GE. A GE is paying a dividend yield that is close to 1.5 to 2 times the amount of earnings it gets. That means that the company's taking on a lot of debt or selling a lot of assets very quickly to service that dividend. You don't want the payout ratio too high. And right now, it is a little bit alarming that the payout ratio is hovering around a 95%. And now, a lot of that has to do with the fact that Altria did make a lot of acquisitions in the past year, and Altria's been spending a lot of money. But if you take an approach that's gonna stretch out that payout ratio and take an average over the past 5 years for the company normally contributes to its shareholders and how much money it normally comes in and how much money that is going to service the dividends, it on average is just under a 70%, which isn't too bad. 95% is a little worrying, and as a Altria shareholder, if that continues to go on into the future, that's going to be a little worrying, because that means that they're not going to be able to grow that dividend safely, and then it also means that if any bad times hit the company in general, there's a higher probability that that dividend gets cut. However, this company has raised its dividend for over 50 years, so as an investor, I'm not too worried about the company ever cutting that dividend, at least for the next, say, 5 to 10 years, because if the company ever cut that dividend, all hell would break loose for the stock. So I do not think anybody, whether it's on the board or on the C-suite, will want to touch the dividend in a negative way. They could slow down the growth and maybe only give like a 1 to 2% growth rate, just so that way they can kind of keep their crown and the dividend kings. But I'm not too worried about that. With this is just a blip. It has happened a couple of times over the past 10 years that their payout ratio got that high, but on average it's trailing between a 65 and a 70%. So I'm kind of be going with that, until the company really starts to mandate that this number is going to be the way it's going to be for the foreseeable future. So I'm definitely not too worried about the dividend getting satisfied in that regard. Alright, and trying to wrap up this video, let's take a quick approach at what the heck is going on with the Juul acquisition and why Altria has been in the headlines so much recently. So Juul is, kind of like the ticket to growth that the company thinks it's going to be experiencing. And now Juul, Altria paid roughly $12 billion for about a 35% stake. Now, when you look at that number, that could seem a bit high, but when you look at it in a different perspective, take a look at the free cash flow that Altria generated last year alone was just under $7 billion. So it came in at $6.9 billion. So essentially, you're only paying 2 years of the free cash flow after everything, after everything is done with the business, the free money that is left over at the end of the year. It only takes 2 years to recuperate everything and then some from the Juul acquisition. And then what people have been talking about in the news recently that I personally don't think is going to happen, but is an option for the company, is that Altria can just write off all of their purchase of Juul, say, over the next couple of years, as a tax write-off. So that means that their overall EPS will then get a cushion, and why it probably wouldn't be the best use of money or the best use of that investment. It means that everything's not going to be going away, and that $12 billion isn't just going to evaporate. It'll depreciate, yes it will, but it will at least not be a total loss for the company. So it's not like they're losing, worst case scenario, an actual $12 billion. But that doesn't mean that Juul's necessarily a bad investment. So Juul is, roughly 80% of the vaping space here in the United States, and they're thinking about expanding it over into China and to Europe. But then all of a sudden, we had a lot of issues with the CDC coming out and talking about a lot of vaping-related issues that were leading to a couple of deaths in some cases, or a lot of illnesses. And a lot of people are freaking out, and Juul, because it is the main player in this space, is kind of taking the brunt force of it all. And, whether or not that holds validity, and if any of you are at all, a victim of this, or that my heart goes out to you, but I do want to put it in a bit of a perspective, because if you actually look at the surveys that were done by the CDC themselves, over 80% of all the issues seem to be related to THC-related products. There seem to be a lot of very bad carts that were getting onto the market, and the running conclusion, at least on the street, is that a lot of people were taking these really, back alley, black market type of carts, injecting them with vitamin E oil, so that way it would fill up the supply, so the sellers could generate more money at the user expense. And vaping vitamin E is very damaging to your lungs, and that is kind of where a lot of people are believing that the trajectory for all the issues and the lung-related issues are coming from. It's not from, say vaping nicotine, it's from vaping that, vitamin E oil essentially. And so again, just to really point out, is that roughly 79% of all the issues with the whole vaping scheme, the reason why everybody is so pessimistic on Altria right now, the reason why everybody thinks that Juul is going to be, say removed and taken off shelves and never coming back, 79% of all those issues are just from THC, say counterfeit products that people were injecting that vitamin E oil into. So the grand scheme of things, I'm not too worried about Juul, and I'm not worried about its longevity or the company's longevity in dealing with Juul, but that's something you definitely need to keep in mind. Because regardless of what happens, based off the studies that are now being done with this, this could either be a major catalyst to the upside or to the downside. But in my opinion, most of the downside catalyst was already priced in. So now you have an asymmetric risk reward if you were to put your money in now and see okay, the ruling comes out and it wasn't Juul's fault, and then you have a massive push. So that's just kind of what I think is going to be, more than likely the way that the cookie crumbles, let's say. And so that's why I'm not too worried about it. And now the final, just to totally wrap everything up and to really summarize everything that I just talked about into raw numbers that you can do at home if you have a free cash flow calculator. If you do a free cash flow calculation on the top line growth of Altria and say I'll show the numbers here, you can price in 0 growth and the company is worth substantially more than it is. But then even if you price in a negative 1% growth for now into perpetuity. So every single year, the company will grow at a negative 1% clip. And again, going back to what I said earlier, is that over a 10-year period of time, they were growing closer to a 5% clip. That would be a big drop. Obviously, in the past couple of years, it's been just under 1% growth, roughly a 1% growth. So that's to go negative. But then even if you let it go negative for the rest of the time and none of the growth vectors work for Altria, and Altria just essentially goes in the ground from here, Altria's price per share target, at least based off my calculator, is closer to $60 a share. So in my opinion, you have a company that's trading for almost a 50% discount to its intrinsic value, giving you almost an 8% dividend yield. So in my opinion, I think Altria is just simply too cheap. And I think that in terms of a value pick and in terms of a cash flow pick and people that are looking for that type of yield on their money, I think Altria is definitely worth a look into. So that's it for this video, guys. There's a lot of information here, so let me know what you guys think in the comment section down below. What are your opinions on Altria? How do you think that they're going to be performing over the long term? Or, do you think that right now is a screaming buy opportunity? Or do you think, I'm backing away from this, man, it's going downhill from here, don't want to touch it? But I would love to hear what you guys think, and thank you guys for sticking to the end of the video. Make sure to hit that like button and subscribe, and I'll catch you guys in the next video. Peace.